Cramer. Welcome to Mad Money. Welcome to Cramer. I'll do my friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate and to teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. This market is driving the best investors I know crazy. And I know why. Incredibly expensive stocks that shouldn't go up endlessly, while stocks of perfectly good companies are completely ignored, or worse, even when they report good numbers, well, they go lower. Stocks that are heavily shorted just steamroll the short sellers like an M1 Abrams tank on the most remotely positive news story. Stocks of companies that go down after news are avoided like the bubonic plague, unless, of course, they are praised by the president for investing $600 billion in the U.S., something that Apple did today that reversed the fortunes of its flailing stock. The result? We have a market that's all over the map, driven not by group moves, but by individual stocks with bizarre narratives that are unlike anything I've ever seen, including today, where the Dow advanced 81 points, the S&P gained 0.73%, but the NASDAQ advanced 1.21%. Let me give you some examples. By now, we all know about Palantir, the one-of-a-kind juggernaut meme stock that can't be stopped. It's part sledgehammer, part laser, part nuclear bomb, and part Saquon Barkley. I mean, this thing's incredible. Now, some of that's because CEO Alex Karp just keeps delivering, not just with great contracts, but with revenue growth and incredible margins. This guy is crushing it like no other. But let me give you the dirty little secret of the success of Palantir. His name is Shane. So I'm at lunch today, and Shane wants a picture. Love that. You always get the picture. Sometimes I'll even ask you, do you want the picture? No hubris, just being nice. I may be a little hubris. In return for the pic, I asked Shane what he's up to now in the stock market. Oh, Shane seemed mystified that I wanted to know what he was doing. Of course I did, I said. Shane said, you know what I'm doing? I'm buying put options. I said, oh, and what are you buying put options on? Palantir. There you go, Palantir. The path to Palantir riches is being paved on the backs of the put buyers, those who use options to bet against it. I told him he needed to focus. He was not focusing. If he was betting against Palantir, he wasn't focusing at all. Fortunately, he limited his risk with puts and not outright shorting. He wouldn't have been at lunch if he were short. He wouldn't even be able to go out in public. Believe me. And look, this short-busting Palantir is not alone. Stocks in this market fly when they're heavily shorted and something good, anything good happens. Take Arista Networks, one of my faves, the data center networking play. The last quarter, well, I got to tell you something. It bombed. The stock's been creeping up ever step by step, inch by inch. The shorts were increasing their bets the whole time. They figured it was a good shooting fish in a barrel. Then Arista reported, and the numbers, they were stupendous.
That was easy.
The last quarter was an aberration. CEO Jayshree Ullal gapped and gutted the short sellers. Like when you catch a bluefish, you gap. The stock managed to shoot up more than 17% today. You don't find ordinary longs paying up like this. It's the short sellers panicking, knowing that they're done. Stick a fork in them. They have no choice but to buy to close out their now losing positions. It doesn't matter how big the stock is. In this market, ever since Liberation Day, the hedge funds feel emboldened to take on stocks. They're willing to take on anything. And for the most part, they keep getting their heads handed to them. Let me give you two salient ones. First is Amazon. The company we know as a retailer put up fantastic retail numbers when it just reported. It crushed in advertising. But when it came to its quiet Amazon Web Services division, the business where the big money's made, the one that competes with Microsoft's Azure division and Google Cloud, well, guess what? We got a whole new narrative. It was one of a penny-pinching Amazon, underspending, and not buying the latest and greatest NVIDIA chips, the ones that young companies thrive on when they want to develop software. This narrative of Amazon being a share donor to OpenAI swept through Wall Street more quickly than the Man Gulch wildfire back in '49, incinerating those who stood by the stock like my charitable trust. No fire department anywhere. But then yesterday, Amazon announced a deal with OpenAI that could be the beginning of an effort to catch up. Customers might not migrate to Microsoft Azure, which is joined at the hip with OpenAI. More important, it was a signal that the shorts had pressed their bets too hard and longs flooded into the stock that had been down 10% between Friday and Monday. This is Amazon. By midday, I wonder if the shorts didn't get wise to the fact that Amazon is no pitiful, helpless giant. If it wants to play catch-up, it will simply spend more money because it's got it to spend. Or how about Apple? Another charitable trust holding. You know what I say about that one. I say hold it, don't trade it. Now, it's been dealing with this has been a stock that's been left for dead after a very good quarter because it has no AI strategy. And it's in the crosshairs of the biggest short creator of all time, or at least it was, President Trump. The president crushes individual stocks for breakfast, like Wheaties. And wherever Tim Cook decides to build phones, the president is going to hammer him, we thought, with tariffs, as long as those factories aren't being built in the United States. Cook wants to make his phones in 2 countries, India and China, and those have become the biggest targets of the president's trade policy. We already knew that Tim Cook had pledged $500 billion to building stuff in the United States over the next 4 years, including some parts of the iPhone. Good, but it didn't move the Trump needle. The president wants the biggest deal of all time, ever. I mean, like, ever in history. The history of all deals. Sure enough, Tim Cook announced today that Apple will increase his commitment to $600 billion and will support a new American manufacturing program, or AMP. If you thought the last one was big, this one is really big, covering 50 states, especially Arizona, California, Iowa, Kentucky, Nevada, New York, North Carolina, Oregon, and Texas. Holy cow. This investment is bigger than the GDP of Vietnam or the Philippines or Norway or Singapore or Thailand. It's creating a country within a country. The United States of Apple, also known as the American Manufacturing Program, will be putting Apple on the course to making the iPhone here. And the president is appeased. Now, you may say, is this all incremental? I say, who cares? If this immunizes Apple from tariffs from China or India because the big man has finally gotten the number he wants, well, then so what? So be it. The shorts will have to cover, which they were doing all day, by the way, hence the stock's 5% gain. Oh, but there is no immunity from a new 100% tariff on imported chips unless they're in the process of building here or made a commitment to do so. I bet there'll be plenty of commitments by the ones who haven't thought about doing that. But then there's the other side of the trade. Stocks that just go begging because there's no narrative that can attract attention. Take Disney. The company made a major deal with the NFL last night on the eve of earnings that were usually positive, but no one cared. Disney reported a nice beat and raise, but one that should have sent the stock flying, but no. Because it didn't raise its earnings forecast enough, the stock got hit. Disney beat the earnings estimates by 14 cents, but it didn't pass all that beat on to the full-year guidance. That's deadly, suicidal even. It's an implicit cut to the forecast. You have to raise your full-year earnings guidance at least as much as you beat the quarter, or your stock is just going to get clubbed. It didn't need to be that way, but management played it safe. Safety took a vacation. Or there are stocks like breakup stocks like Honeywell and DuPont. Both reported excellent quarters, the latter being a real standout. But like Clark Gable, at the end of Gone with the Wind, this market said, frankly, my dear, I don't give a damn. These stocks may languish until their next quarters because no one can think of a reason to take either side of the trade until we get closer to the actual breakup. So here's the bottom line. In this market, haters going to hate, okay? And when they hate and they're wrong, they turn into buyers. And lovers, they just keep buying. And when there's nothing happening, even if the stock is dirt cheap, who cares? In this market, the answer is nobody. Jim in Wyoming. Jim!
Oh, thank you for taking my call.
My pleasure, Jim. What's up?
I've been listening to you since Kudlow and Cramer.
Now you're talking. That's like 62 years ago. Before they had, they were still using vacuum tubes back then.
I wanted to thank you because I listen carefully to the advice that you give. And, of course, you give us the facts. You have great interviews with company officials. And I've been investing based on that. I do the homework.
Excellent.
And then
Excellent. Not on politics. I tend not to pick on politics. I like to make money for people, not just confuse them. Have you ever read a Stephen King book?
You've increased my net worth by a substantial amount, and I'm very grateful. So thank you so much.
Oh, terrific. Thank you. You know what? Come on. How about the hand? How can I help you now?
PayPal, buy, sell, or hold?
No, I didn't like the quarter. There's so many other better ones out there. May I suggest if you went lending, I would go with Capital One. I know it's old-fashioned. I know you've seen the ads. But all I can tell you is the guy who runs that situation, Richard Fairbank, is a genius. He's who we're going with. I'm going to take one more. I'm going to go. I don't go to West Virginia. Christopher in West Virginia. Christopher.
Booyah, Cramer.
Booyah,
quick,
Christopher.
Just wanted to give a big shout out to my mom, dad, and brother in the Philadelphia area. Go Birds.
Holy cow. I mean, I'll see them on September 4th. What's going on?
I'm calling about Coca-Cola Consolidated. Ticker symbol COKE. Split back in May.
No, Christopher, no, we're not going there. That just doesn't have it. It's down 10% for the year, and that actually makes sense. It does not have a technical term that I like to use periodically that I learned at Goldman Sachs. The mojo. It doesn't have it. In this market, if you're not making some crazy news, well, no one seems to care, even if your stock's dirt cheap. On Man Tonight, Planet Fitness posted a top and bottom line beat on today's earnings, but they didn't raise the heart rate of the stock. I'm going to talk to the CEO, find out what's going on. Then as we head into the rest of the year, How narrow is this bull market going to be? I'm going off the charts to find out, and I'm getting exclusive with sports betting player DraftKings, fresh off a dynamite quarter. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
What are we supposed to make of this quarter from Planet Fitness? The gym chain known for its beginner-friendly, judgment-free zone philosophy and its affordable $15 per month membership fee. This morning, the company reported a strong top and bottom line beat, much better than expected same-store sales. But because maybe management didn't raise their guidance to reflect these excellent results, and because management talked about higher attrition from the rollout of their online cancellation policy, the stock ended up getting hit. At one point, the stock was down as much as 10.5%. Although it rebounded from its lows and finished nicely, it's just down nearly 3%. So is this the pullback a buying opportunity, or did the stock deserve to get hit? Let's take a closer look with Colleen Keating. She's the CEO of Planet Fitness, who rang the closing bell here at the New York Stock Exchange to celebrate 10 years as a public company. Ms. Keating, welcome to Mad Money.
Hey, Jim, great to be here. Thanks for having me.
Okay, so 10 years. Give me a little bit of what's going on during that period. You've been here for a year. I think that the numbers are just extraordinary. What's been going on at Planet Fitness?
Yeah, so I've been here just over a year, as you said, and we've really leaned in on our strategic imperatives. So those are really to refine our brand and pull it through our marketing, lean in on member experience and enhance our member experience, optimize our floor plan and our format to make sure that we're relevant and staying relevant for today's consumer. And then when we get all that right, we accelerate growth. And coming off the quarter, we had a great quarter. The strategic imperatives are coming to fruition, and we saw our marketing really land. Our join numbers were tremendous in the second quarter. And the format optimization that we've done, changing the gym floor, is certainly resonating with us.
I agree. Now, when you post an 8.2% comparable store sale versus 5.9, what that says to me is someone thinks there's great value, because that's what's working, value. So people must feel that they're getting a more bang for the buck versus, say, other gyms, but maybe more expensive.
Well, when I think about value, I think about high value, right? I always say HVLP, high value, low price.
Saw that in your stuff.
The HV has to be capital, because we offer a tremendous value, top quality equipment, super clean, modern clubs, at an incredible price point, an incredible value, $15 a month.
Okay, so let's talk about what's going on in the country. We've got a cohort, Gen Z. If you were at a liquor company right now, I would be telling you, you know what, I think your days are numbered. Because there's this whole cohort of people who's growing that doesn't want to do bad things to their bodies. Now, that the corollary goes with that. They want to do great things to their bodies. So Gen Z signing up pretty aggressively.
Gen Z has been the fastest growing segment of our membership. And keep in mind, there's 3 years of Gen Z that aren't even of age yet to join our club. So fastest growing segment of the membership. And we're seeing increase in our utilization rates as well. And we know that Gen Z is a high user.
So explain that to me. So in other words, they sign up and then they use it more than others per month.
We used to see that we'd have about six visits per month from a member who utilized our club in a given month, and we're seeing in the high sixes over the last couple of quarters.
Now,
so utilization is up, which means they're having a great experience.
So where are you getting the people who want to do the franchising?
Our franchise, we have a very strong complement of franchisees, and many of our franchisees have grown with our system over a long period of time. We've also had some new entrants, but sophisticated franchisees who are great thought partners for us and really invested in growing their business with Planet Fitness.
I always tell people, to get a franchise at Planet Fitness, you already have to have a franchise. Your people tend to be multiple, right? Because they're very good at what they do and they understand the rules.
They tend to be multiple, and when we have had small portfolios trade, in almost every case, we've had incumbent franchisees who've been interested in taking on additional clubs.
Okay, so I'm on the road a lot. If I have a Planet Fitness, I imagine the one I belong to is where I get for $15 is the one I have to work at. But you have another feature that would make it so when I'm on the road, I could just go downstairs in one of the buildings that I work at, and there's a Planet Fitness.
Yeah, so that's our Black Card membership, and It has many benefits. However, the top two benefits of a Black Card membership are reciprocity, which is what you're saying. You can use any club in the country, or bring a friend, and they're able to bring a guest along with that membership. And we've seen increasing penetration with our Black Card membership. So we're at 65.8% of our membership today opts in for the Black Card membership at the slightly higher price point because it's such an incredible value.
Okay, so one of the things that you had to go through a tough period in COVID, and you came back, and I was afraid that it would not be, that it would be a moment where people, maybe they would change the way that they worked out. It turns out that it didn't even stop. That Planet Fitness kept advertising, never really quit, but you picked up a lot of share during this period.
We did, and when you think about the COVID period, certainly there were some temporary closures for municipal reasons, right? But we did not have one club permanently close coming out of COVID.
That's incredible, isn't it?
It is incredible, and it also speaks to the fact that people are more fitness-minded than ever. I often say we're in the golden age of fitness. So across all generational cohorts, we're seeing people more fitness-minded and more thoughtful about a fitness routine and movement as part of their lifestyle, both for physical reasons and for emotional and mental
reasons. I want to just drill down on that for a second. Candidly, when I was the age of Gen Z, was a time when I was very wild. I've written about it, so I'm no stranger to it. I hit it pretty hard. Because that's what you did. They don't do it anymore.
Well, and think about this, too. So when I was growing up, and we're probably similar vintage, when I was growing up, I don't remember my parents or my friends' parents going to the gym or talking about having fitness as part of their lifestyle, or even really having, the piece of equipment in the basement kind of thing. And, today, I think millennials, Gen Zs, they've grown up more fitness aware and fitness more a part of their lifestyle. At the same time, we're seeing them value community. And maybe that's come a little bit of coming out of COVID, right? That they were home, they were being schooled at home for a while, and the sense of community that we offer at Planet Fitness. So top quality gym, great fitness routine, the top shelf equipment. At the same time, this welcoming sense of community that serves gym goers of all fitness levels.
Well, it's been a great performer versus the S&P during this whole period, last 10 years. I want to congratulate you on that anniversary. It's terrific. And I know that, to me, you may get a little bit of a buying opportunity because of the drop today. That's Colleen Keating. She's the CEO of Planet Fitness. Man Money's back after the break.
Coming up, is the market's recent pullback a buying opportunity, or should investors buckle up for more turbulence in the weeks ahead? Cramer is going off the charts to find out. Next.
All right, what do you make of this bull market? It took a real beating late last week. One we've only partially recovered from, frankly. Regular viewers know that what I think of the labor report and what it means for the Federal Reserve. I'm optimistic about a September rate cut. But this is a tricky market. Even though the bulls have had a good year, it's also been a volatile one. And a whole lot of people have been very confused every step of the way. As I said at the top of the show, people are shorting all over the place. And that's why at moments like this, I can take my own opinions out of the equation. Consult something more quantitative. We call them the technicals. So tonight we're going off the charts with the help of Jessica Inskip. She's the first woman on the active trader desk at Fidelity, who's now director of investor research at stockbrokers.com, as well as the co-host and founder of the Market Make Her podcast. In order to get a better read of the environment, I like this. Based on the action, Inskip thinks that we're still in bull mode, thank heavens, but we could be headed for a period of heightened volatility. Let's start with the weekly chart of the S&P 500. So here we go. After last Friday's pullback, Inskip says the S&P is now experiencing a healthy pattern of price retracement, but the bulls are still in charge. That's what matters. In fact, she thinks this is a secular bull market, not a shorter-term cyclical one. Cyclical will be like this, and secular would be like this. Earlier this summer, the S&P broke through the ceiling of uncertainty at 6,147. Okay, 6,147. They're right here. See the breakthrough. The level that we previously peaked at in February. Last time we heard from Inskip in May, she said we need to clear this ceiling before the market can get moving again. Not long after that breakthrough, the 13-week moving average crossed above the 26, 13 red, 26 brown. Okay. And remember, Inskip likes to use these 13-week increments because 13 weeks is one quarter. And the quarter is the basic unit of measurement in this business. With the 13-week crossing above the longer-term moving averages, that shows that the S&P is in a bullish trading mode. Okay, that's very positive. However, when you look at the light purple Bollinger Bands above and below the action, these measure volatility, by the way, they're getting wider. That means we're dealing with an environment that's primed for more volatility and uncertainty. See, the Bollinger Bands represent 2 standard deviations away from the 20-day moving average. The wider the standard deviations, the wider the price range. Inskeep wants to see these bands narrow. The fact that they're weak, they widen, it tells us the S&P may have moved up too far too fast. See, this is too much space between. That makes sense. I remember John Bollinger in the old days. Wow, this would be something where you would say, I'm getting dicier. Basically, she thinks the bull market is still strong, but it's gotten a little ahead of itself. If we do get more of a pullback, Inskeep says you need to watch that former ceiling of uncertainty at 6147, okay? Although as long as we're above it, it's more like a floor of certainty. As long as the floor holds up, we're in good shape. Let's take a look at this second chart. Next, we need to look at the weekly chart of the S&P 500 equal weighted index. Now, in the regular S&P, every stock is weighted by its market capitalization, which means that, for example, the Magnificent Seven alone can move the whole index higher. In the S&P equal weight, every stock counts the same. That's why Inskeep likes to watch it in order to get a read on the other 493 non-magnificent stocks in the cohort. I like this. I am a big believer in just using the S&P, but I like this. And looking at the S&P equal weighting, it's clearly not doing as well. Unlike the regular S&P, the equal weight failed to make a higher high. Look at this. This is really not special at all. And Inskeep thinks it's just showing early signs of a bearish divergence. First off, the S&P equal weight is stuck between a floor of 7,384 and 7,612. That floor of support goes back to the higher high the index made back in mid-October. Okay. The ceiling of resistance comes from the index's all-time high last November. We haven't been able to break through that ceiling. Basically, the normal S&P is in a clear uptrend, making higher lows and higher highs. We like that. But the S&P equal weighting failed to make a higher high. And without the equal weight, any rallies are going to be narrower than we've gotten used to. Hence the recent comeback from Magnificent Seven, which, I don't mind, but most people feel it's like too narrow. Unfortunately, when you look at the moving average convergence divergence, or the MACD line, now that's at the bottom, this is an important momentum indicator. It's flashing a bearish divergence. Inskeep doesn't like that the MACD is making lower highs while the actual S&P equal weight is testing its old highs. That's not a good sign. The MACD can often detect changes in trajectory before they happen, and right now it seems to be changing for the worse. You can see. But for Inskeep, that's just a warning sign. She won't get truly negative on the S&P equal weight until it makes a weekly close below its floor of 7,384. So it's got to go below here, okay? Down about 40 points from where it's currently trading in. Although she says that's too close for comfort. I get that. Now, if the S&P equal weight shows that the bull market's narrowing, we need to look at the part that tends to hold up in these situations. Tech. So check out the weekly chart of the Technology Select Sector SPDR, SPDR fund, and the XLK. Okay, so now I want you to stay focused on this. We're going through tech now. Okay. And look, the XLK has been doing very well. It's broken through key resistance levels in recent weeks, including the one that Inskeep called out the last time we highlighted her work. This is nice. However, even though the XLK has been doing well, she doesn't like the Bollinger Bands. Remember, that's the purple here. They've been widening recently, and that means more volatility. Even though this tech index is well above its floors of support at 242 and 237, Inskeep says it's very important that we remain above those levels. Otherwise, we risk a real breakdown. Now, that's bad news, but I think we're going to be comfortable doing that, and we got some good action today. Fourth, why don't you take a look at this chart of the XLK, the tech index, relative to the U.S. dollar. As you see, whenever the dollar rallies, the tech sector gets hit. Remember, the dollar here, you can see what's going on. As the dollar goes up, this is the U.S. dollar, and this is tech. Whenever the dollar weakens, the tech sector tends to rally. That's because, let me just be sure you understand. So this is going down, that goes up, okay? Pretty good with me? That's because many of these companies do lots of business overseas, and their foreign profits are worth more greenbacks when our currency's weaker. Lately, the dollar's been hit hard. I like that. Most people don't, but I think that I'm from this tech world. And it's been good news from the XLK. However, Inskeep's worried that we may have come too far too fast here, too. She's not saying she wants a stronger dollar, but she'd feel more comfortable if it stabilized at these lower levels. I want it to continue to get weaker so our companies get the advantage that our foreign companies have been be able to take advantage of us so long because of the strong dollar. Anyway, here's the bottom line. The charts interpreted by Jess Gibbs suggest the S&P 500 is still in bull mode, and that's even after last Friday's beatdown. But it looks like we're back to the narrower bull market that's defined so much of the past year and a half. You and I both know NVIDIA, Apple, Microsoft. Okay, these are core names for us. For a lot of people, they're not. But they're core names for us here in Mad Money and for my charitable trust. Now, let's take some questions. Let's go to George in Florida. George.
Jim, good afternoon. Bristol Myers, like all my big pharma holdings, has not done very well in the last several years. I just don't understand it. Bristol Myers has a very good dividend. They're profitable. If their stock keeps going down several years ago.
Yes, it does. And let me tell you how I feel about this. I made a mistake here. I bought the stock. I bought it because they have a drug called Cobenfy, which I think is going to be really good for severely mentally ill people. It has not worked. The president is very much because he's against these drug companies. It's not been able to stabilize. I'm trying to figure out an action plan for my charitable trust. I've not been recommending the stock. I need an action plan. I don't have it yet. You and I are in the same boat on this one. I want to go to Marina in Florida. Marina.
Hi, Jim.
Hi, Marina. How you doing?
I'm good. I'm a first-time caller, and I'm new
Excellent.
to this investing. And I have one question. Would you suggest buying Micron stock now at its current stock price to hold for growth?
The problem has happened, and it's very technical here, but they make a particular chip called a DRAM. And the DRAM pricing has been going down, and that's what this stock trades with. Not with the stocks, not with the semiconductors, but with actual DRAM pricing. Until DRAM pricing stabilizes a little bit more, I'm going to say we have to wait. I wish I could be more aggressive because I happen to think that Sanjay Mehrotra is a terrific CEO. But it's a commodity, not unlike in some degrees oil. Now, I do have this high bandwidth division that is very good for data centers, but it's not enough to be able to move the needle. And that's why I am waiting on the sidelines. Micron. Right, the charts as interpreted by Jess Gibbs suggest that this bull market can continue. But it'll probably be back to the more narrow one we saw earlier this year. I say don't sweat the program. Now, much more Mad Money ahead, including my swiss with DraftKings. As the NFL season approaches, I'm finding out how the company's preparing to double down on its priorities this year. Then we all want to invest smartly in stocks, but sometimes it can be hard to know where to start. I'm keying you into my method for how to go from a hunch to a holding. And of course, all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. As we approach football season, things are already looking pretty darn good for DraftKings, one of the nation's largest online sportsbooks. I've been steadfastly bull on this one, just the whole way. After the close, DraftKings reported an impressive quarter. Revenue growth accelerating to 37%, better than expected earnings, higher than expected earnings for interest, taxes, depreciation, and amortization. These results were driven by what DraftKings calls a sportsbook-friendly outcomes in the quarter. And the company only reiterated its full-year forecast, but management did say that it now expects to see revenue near the high end of its guidance range. That was good enough to send the stock flying in after-hours trading. But what's the long-term bull case here? Let's check in with Jason Robbins, a friend of the show, co-founder, chairman, and CEO of DraftKings, to get a better sense of the quarter. What comes next? Mr. Robbins, welcome back to Mad Money.
Thank you for having me back.
All right.
Great to talk to you.
Yeah, Jason, well, look, this is a pretty good number, really good set of numbers. What's driving these numbers? Because it's not a quarter that I would necessarily expect to be as strong as it was.
Well, first, thank you. It's we're really excited. It's a huge record for us. It's to put in perspective, more than double our highest adjusted EBITDA quarter previously. So really great to see. Q2 is a good quarter. There's definitely no football, which hurts a little bit. But you got NBA, NHL playoffs, baseball starting, and more importantly, it's a quarter that we really are able to make more profit because it's not our heaviest marketing quarter. Q3 and Q4 and also Q1 when you have NFL going on has more marketing spend going. So definitely a good time to make profit, and we're excited about the numbers, over $300 million for the first time ever. We're really excited about that.
Now, Jason, one of the things I did see, you kind of alluded to that, but it looks like each gambler's gambling more, and the gamblers don't cost as much to be able to get. I would think that that's just kind of that it's really an inflection moment, and you could be on the cusp of some very big numbers.
Well, I think right now we're at a great stage where we're still seeing a ton of growth and really also able to start making real profit. So I'm excited about that. The numbers look great. We have an increase in our year-over-year players. We have an increase in spend per player. Had a little bit of friendly outcomes in the quarter, which was nice. It swings both ways. People can see now. It was tough after the last 2 quarters. We got stung, but good to have the other way. And, really excited about the upcoming NFL season, too. We have some big bets coming in on that already.
Well, I wanted to ask you, I always think of you guys as innovation. I like to just check to see what you've got going. You've got some stuff for me for opening day, September 4th with the Eagles.
Oh, yeah. Well, Eagles right now are the second most bet on team. I hate to say not first, just behind the Lions. They are the favorite, though, so maybe the Lions, people like the odds a little better. Believe it or not, Jim, somebody put a $25,000 bet on the Raiders to win the Super Bowl at a $2.5 million payout. $2.5 million payout. If
well, you know what? I don't know.
So,
that's like a long shot stock. Maybe that's Palantir for all I know at 30, right? I mean, who can tell? They got a new quarterback. It could be. Now, when you talk about the sports friendly outcomes, is it like, for instance, JJ Spawn won the U.S. Open in golf. That was people didn't think that could happen. So that could be a good day, a good series for you guys.
Yeah, I mean, usually when the favorites win, it's not as good for us. So when you see a long shot like that win, it's usually good for the books.
Now let's talk about this prediction betting. Robinhood gets it. I don't think they have anywhere near the safeguards that you guys have to constantly. I mean, look, candidly, a lot of times when I'm looking at your ads, it says it's gamble, but don't gamble. I mean, I always feel like okay, I'm warned. But I don't know. Robinhood doesn't have that kind of protections for the people who are gambling.
Well, listen, I think that federally regulated markets it's a different regulation system, and I'm sure they're following the rules that they need to. For us, it's an interesting area. We're keeping an eye on it. Obviously, something that we need to take seriously and figure out a strategy around. But I do think it's a different regulatory framework, and you can argue whether you believe or not that they're appropriately regulating any of these things. But I do think it's an example of where you see the sports betting and online gaming that's state regulated. It's much heavier than most other forms of regulation. And so when I hear people say it's not enough, it sort of surprises me, because relative to a lot of other activities, it's a much more heavily regulated industry.
Well, look, I love daily fantasy. You know that. Daily fantasy is one of my favorite things, particularly when my team falls back. You know that. But, California, you've got some state attorney general. He's against daily fantasy.
Well, we obviously don't agree with him on that. We've been operating peer-to-peer contests there for over 13 years, and I think it's pretty established that that's clearly legal under California law. But we're going to work collaboratively with that office as well as with any regulators that raise issue. And, I usually find that once you can get in the room and explain the facts, people get it.
Now, how about this OBBBA, the beautiful bill, gambling tax implications, where it's possible that because they changed the law, we had a piece on this, it's possible you could end up paying tax when you haven't made money. That doesn't seem right.
Yeah, it's a very strange change, but my understanding, it was done as part of a technicality in order to follow the Byrd rule, which is about as far as my expertise here goes. But I don't think that there was really a total understanding of what that meant, and I do think there's been some appetite you've seen to fix it. Right. So, we're trying to work with congressional members to do that, and hopefully we'll be successful. I do think it's something that doesn't make sense. If you can't deduct all your losses, how does that make sense that you pay income tax on something that's not actually income?
There would have been a time where our whole conversation would have been different. I would have said, look, until California, until Texas, until Florida, until you get those, I'm actually not that interested. What do you think is the big change that made it so that didn't even come up in the discussion until the end of the interview?
Well, listen, I think the fact that it's such a big TAM, and we do have quite a bit of legalization outside of those states, and those states I think will eventually come, right? It's just a matter of time, at least some of them. But, obviously the biggest states are the ones where you have the most stakeholders and sometimes take the longest. And I do think that there's been progress made across the board. So I feel eventually there'll be close to 50 states with sports betting, and I can't imagine a world where you can, bet in 30, 40 plus states, and California is not one of them, and Texas is not one of them. So I think eventually that will happen.
All right, one last one. It's kind of it's a little bit away from it, but my daughter asked me to ask you, when you had those bets, where it's like an anytime touchdown Mahomes, which is to open an account, has it ever been such of a layup and yet not pay it off?
Usually when we put those out there, we know they're going to pay off because it's intended to get somebody excited and open an account.
I think that those are the most. I always tell people
it's a fun way to experience the product, right?
Because people realize what it's like to win. It's absolutely terrific. Well, you're great to have on, Jason. Jason Robbins, DraftKings co-founder, chairman, and CEO. After a terrific quarter, Jason, I love having you on the show. Thank you.
Thank you for having me.
Everybody's back there for the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time to talk about the lightning round. Well, let me say this. Talk about myself. The call stock presented by Step Square. Play this out. And then the lightning round is over. Are you ready? Ski that to the lightning round. Let's over with Ilham in Virginia. Ilham.
Hi, Jim. How are you today?
I am good, sir. How are you?
Very good, very good. Thank you very much. I have a quick question. You have been invited a number of times as CEO of the company. The stock did very good, and in April it went down like all other stocks, but it never recovered back. So my stock is Salesforce, CRM.
Okay, so Salesforce is a little tough right now because right now the enterprise software companies are all coming down. I have not been recommending the stock hard. I want to see what happens with the quarter. I wish I could be more definite, but sometimes it's better just to say I don't have a handle on it. I'm going to go to Antonio in Massachusetts. Antonio.
Booyah, Jim.
Booyah, Antonio.
Thank you for taking my call.
Of course.
What are your thoughts on Oklo?
Okay, I believe in nuclear. I believe in nuclear power. I believe in their strategy. I do think that the company at $12 billion is not a bad buy. It has been up a huge amount, 290%. Let's be a little careful, but I think it's a good company, good stock. Let's go to James in Georgia. James.
Hey, Jim. This is James from Georgia.
Okay, what's up, Chief?
Not much.
All right.
I've been looking at a stock that's recently dropped by 45% for the last 2 months. Okay. What's your opinion on QuantumScape?
I'm not a fan of QuantumScape. I don't think they have the horses. I don't like companies that continue to lose money. It's just not my style. I want to go to Hardy in Illinois. Hardy.
Hello, Jim. How's everything going?
It's going incredibly well. How about you?
I'm doing fine. I'm doing great. I have a question. I've been in this stock for quite some time, and I'm trying to determine if I should buy more of it. The ticker symbol is NIO. It's NEO.
You know, I don't think that is a really terrific situation. I happen to think that there are better buys, and I think that market is flooded right now. Let's stay away from that one. Carla in Florida. Carla.
Booyah, Jim, from
very strong, very
Florida.
All right.
Thank you.
Oh, I like it there.
I'm a listener. Well, my husband and I are listeners from the start, but my first time calling.
Okay.
My stock is Riot.
No, see, that's that's just too dicey for me. I know in the end I may look like a radical, but I'm not when it comes to money, except for when it comes to orientation and not just doing S&P funds, but also doing individual stocks. Let's go to Ian in Florida, please. Ian.
Booyah, Jim. How you doing?
I'm doing well, Ian. How about you?
Amazing. Thank you so much.
Of course.
Jim, a four-time caller, investing club member.
Yes.
Very happy.
Excellent.
Jim, looking at a chip stock, it reported recently, and it got hit more than a little bit, and it's down today. What do you think about AMD here?
I think this is the pause that refreshes. I like the pullback. I'm surprised we're even getting it. I think that Lisa Su has got something big going on with this MI400. That's a competitor to NVIDIA. There's room for them. Even if they do billions and billions of dollars in that category, they'll get their fair share. I want you to buy some. Let's go to Pete in Alaska. Pete.
Booyah, Jimmy Chill from Anchorage, Alaska.
Good to have you, man. Good to have you on the show.
Hey, man. You have provided me effective investing navigational beacons for over 2 years, ever since I divorced my financial advisor at a fraction of the cost, my friend, and I am appreciative of that.
Thank you. I try to bring it every day. All right.
Dude, you do. Hey, so I need a navigational beacon on ISRG. Should I?
I can't believe that ISRG is getting hit like this. I like that company so much. I don't want to go out on a limb and say buy it. I would say you can buy small. It just doesn't act well enough. But boy, it's a good company. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
If you're going to buy a stock, you need an edge. You can trust your eyes and ears, most certainly, but before you pull the trigger, you need to be sure that the company itself is on solid ground. It's a big theme in my new book, How to Make Money in Any Market. If you have powers of observation, you might see something others don't. If you're curious, you can follow up on the hunch. These days, there are so many ways to follow up on that hunch that it's extraordinary. These kinds of things used to be very difficult, but now it's never been easier. I love going to ChatGPT, Perplexity, I wish Apple would buy them already, or Gemini, Grok, Claude, and since the last Meta quarter, Meta AI. It's key that you get the prompt right on each so you get uniform responses. Now, I'm fortunate enough to also get the work of Rob Pace. He's from 100X, which is an alternative data firm that we've started to use recently. You've seen them on air, which sources insights on consumer companies by asking real people what they're planning to buy, rather than making judgments based on their past purchases. So I'm marrying my anecdotal insight, which is somewhat valuable as a place to start, and then trying to get an empirical readout on the company. The anecdotal empirical nexus is the heart of good stock picking. Once you have that, you need to make sure you're standing on solid ground with the fundamentals, the actual sales, earnings, margins. Let me give you some examples of battleground stocks that Rob has helped me with so you can see how we go from sketchy firsthand experience to a broader understanding of the underlying business. Let me start with Reddit. I use Reddit pretty aggressively. It's a terrific product. My wife uses it to sell Fosforo, her mezcal brand, because Reddit has an entire mezcal forum. So I like it. The advertiser likes it. That's where I start. I then try to find out what other people feel the way, whether they feel like I do. Rob has told me that Reddit customers are planning to increase future use because people love crowdsourced information. Seems to be able to be independent. As he sees it, Reddit demonstrates the increasing value of human intelligence. Increasing value of human intelligence. I like that. In fact, he's betting that as the future of search evolves from finding things to figuring things out, Reddit could be a major winner. Now, you take your own use, as I have. You marry it with your wife's experience selling a lot of Fosforo mezcal in the mezcal section. You then take data from 100X to see if your experience lines up with reality. Only then you go to the web, you look up articles, check out websites to see things like the piece we ran on Reddit a couple days ago, which said it was great to buy. Wow, that's been terrific. To me, that produced a terrific and really special reason to buy the stock, and I'm sticking with it. I just wish I bought it for my charitable trust when I first got the hunch, but I hadn't done the homework. Can't jump that. 100X has pointed out a host of things that have helped me. How about this one? When I get my Starbucks caramel latte, my request in 4 minutes, that used to be much longer. Much longer until recently. 100X tells me that I'm not alone. They're starting to see something similar among Starbucks customers that they canvassed. I like that. Any confirmation that makes my anecdotal thinking feel like the empirical one is good for my charitable trust position. And I just told club members to buy some more. It makes me want to buy even more when I think about it. So remember, first you start with the anecdotal from your own powers of observation. Then you try to get empirical data that agrees with what you see to confirm that you're not an outlier. Then you extend your curiosity to the basic homework. If everything holds up, then you've got a stock that you can happily buy and then buy more of if it comes down. So important in a tough market. If you have the right information and you're a believer, your odds of a successful investment are just much higher. Anything that increases those odds, that's what Mad Money is all about. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.